I think it's so easy to paint a really negative picture of the outlook right now and say we're about to go into a recession. I think that's kind of a bit of a sellout at the moment, because it might sound good when you're talking about all the risks and you might sound really convicted about that view, but I think that the issue that we're having at the moment is that most people are really uncertain about where the future's going to go, because we have a lot of dynamics at play that mean we can go down the path of a downturn or a recession, because there are these growing risks and central banks have hiked rates so much. But more probably, we're just going to continue in this environment where growth is slowing, interest rates will slowly be cut, and you kind of just have this weakened growth environment. Now, that's not necessarily bad for equities or for growth assets, and that's really the point of today's presentation, is that I think we are going to be in a bit of a sweet spot for the equity market in the next 6 to 12 months. But in terms of the first part of your question, bury your head in the sand or not, I think it depends on the event. So with something like the Russia-Ukraine war, that did actually have a long-term impact to markets from the point of view that it was inflationary. With something like Israel and Hamas, there was a short-term reaction with share markets. I think that they fell by about 5% peak to trough. But again, with geopolitics, it's so hard. Like when we were looking at the impact to markets, it's really hard to know when a share market's responding to that event or when are they responding to something else. And it's so arbitrary. So a lot of geopolitical analysts, can fiddle with the numbers when they see fit. I mean, what date do you assume that share markets responded to that? Was it the day of the event? Was it the day after? Sometimes share markets don't respond to an event for days because they don't really know what to make of it. Sort of like with the US election, you may not see you may see an instant response, and then the response a week later from share markets could be something different, which is exactly what happened with Trump last time. We saw a big negative at first, and then we saw a big bounce back in share markets as they thought, oh, actually, we're going to get all these tax cuts coming through. And the same thing with geopolitics. We would think about it as, does this change the long-term philosophy for how we see growth? I think Russia and Ukraine was a good example of that it actually led to long-term inflation and was one of the reasons for why we saw continued increases to commodity prices. So it does depend on which particular event. So you can position your portfolio, but sometimes it's better to position it for after the actual event occurs because you just don't know what impact it will have.